Good evening, everyone. Welcome to our Mississippi State University Alumni Association workshop. My name is Jason Maida. I'm with American Pacific Mortgage. I'm going to be your presenter for this evening. Really excited that you took some time out of your busy schedules to join us for tonight's class, and we want to give you a lot of value in tonight's class. Our run time for the workshop will be just about an hour, so we'll have you out of here at the top of the hour. This is a very interactive session, so as I go through our content tonight, we encourage you to ask questions of us. We'll answer those on air for you. Now, in Zoom, you can use the Q&A function. Just go ahead and put your question in there, and then myself or my colleague, Ken, who's also going to be kind of watching the questions coming in, we'll take those and answer those on air. This is our final workshop for our partnership with Mississippi State alumni, and really excited that you can get a chance to maybe spend some time with us because, as we're wrapping up 2024, maybe homeownership is a goal for you in the new year. And so hopefully this will give you some tools and some resources to kind of think about on that path towards homeownership. All right, well, let's go ahead and dive in and just to give you a little bit about more information about our organization. So I work with a company called American Pacific Mortgage, or APM. We're a nationwide lender. In fact, we're the top 10 lender in the country. Our team in particular focuses on first-time home buying and kind of what that experience looks like, and try to tailor like home buyer resources and tools around you to support you on the path towards home ownership. And so we do that by providing resources like our classes here. Now, if you enjoy all the content that we give you this evening, we'd encourage you to share this with your friends, family, and coworkers. We're recording tonight's class, so this will be posted up on our YouTube channel. So if you need to step away from our class tonight, it'll be live, be available for you to access tomorrow. We're also going to share with you all of our presentation material. Again, my name is Jason Maida, and it's a pleasure to be your presenter this evening. Really enjoy getting a chance to share this content with you. And here's what we're going to talk about tonight. We're going to spend some time looking at a budgeting exercise, kind of like what does it look like to compare renting versus buying. I'm going to walk you through a little bit of a calculation for that. Then we're going to spend some time looking at the housing market. So we're going to talk about prices, where they're going, maybe some early indications of where we think prices might go, given what we look at is the interest rate environment. So we are going to spend some time looking at interest rates. And so we're going to kind of see kind of what that looks like for us. And then from there, we're going to spend some time looking at, different credit scenarios and kind of give you some tips and resources on credit. And then we'll go and transition into talking a little bit about student loans, various loan programs that are available to you. If you're thinking about taking the next steps in homeownership, what type of documentation do I need to get together? We'll also spend some time looking at resources around first-time buyer programs. So whether you're in Mississippi or you're in Texas or any other neighboring state, there's various assistance programs that are out there to help make homeownership more of a near-term goal for you, especially if the challenge is saving up for homeownership. And then finally, we'll wrap up tonight's discussion and look at the buying process. So after leaving tonight's class, you may say, hey, you know what? I really want to think more about homeownership and maybe put together a plan for myself for next year or beyond. We're going to give you the steps in how to do that and what you should expect as a future first-time home buyer. Well, when we think about home buying, it's probably going to be one of the biggest financial decisions you have to make in the next few years, right? And so when we work with our clients to design plans for home ownership, it really centers around, first of all, looking at the benefits of owning a home. And I think it's important to understand that owning a home is not really a fair comparison to renting. Really, it wouldn't be like an apples to apples comparison, because there's a lot of great things that come along with home ownership. For example, when I purchase a home, I'm able to kind of control my monthly outgoing expense, my budget that I have in home ownership. Versus as a renter, I'm really at the mercy of what the landlord ultimately wants to charge me from a rental perspective. And there is opportunity because this home is an asset for it to grow in a value over time. The difference between what my home market value is versus what my balance is owed on my mortgage is the home equity, the value, the asset that I have as being a homeowner. Now, and because this is an asset, this has the opportunity to create generational wealth for our families, right? For most of us, a home is probably one of the biggest investments we have. And believe it or not, there's still some really good tax benefits that come along with owning a home. And so when we consider home ownership, we really encourage our future buyers to think more through that when they're considering taking that step into home ownership. Now, one of our ways that we kind of prepare home buyers is kind of looking at a rent versus buying calculator. And we're going to kind of spend some time looking at a tool brought to us by Freddie Mac. And before I do that, I just totally forgot to ask the audience, but I know our audience is kind of all across the country, but it would be super helpful, especially as we get ready to talk about the housing market, to share with us where you're joining us from. So if you feel comfortable, just drop in the chat what state you're joining us from, if it's Mississippi or if it's, you're in Alabama or, Tennessee, whatever state you're in, or Texas. Love to kind of get a sense of that, because as we talk more about the housing market, obviously there's some different trends in those markets. So, and I appreciate those that have already dropped that in the chat. So thank you for that. Very cool. We have somebody on the West Coast. I see Arizona's representing. So yeah, I had a pretty good feeling that I think some of us are kind of dispersed across the country, although most of us are probably in the Mississippi market. So thank you for sharing that. And let's talk a little bit about this rent versus buying calculator, okay? And as you're preparing for home ownership and figuring out, does this even make sense for me? Obviously, budget's a big part of it, right? We got to make sure this is going to be an affordable option for us. And so we're going to walk through a calculator for that. And as I mentioned earlier, we're going to share all these presentation materials with you tomorrow morning. So we'd encourage you to take some time, dive into that calculator yourself and kind of see what things look like. So let's spend some time, and I've pre-filled some of these fields just so we can keep ourselves on track for our runtime for tonight. But let's kind of walk you through that. And the first section of this calculator, first of all, talks to renting, right? So if we're renting a home, how much are we paying? So I assume, let's say $1,500 a month in rent. Then we have generally renter's insurance expense, which we have at $15. We have our rental increase. So we assume that maybe our rents go up by maybe 5% on an annualized basis. So when I decide to maybe renew my lease, it might increase by 5%. And then we have the next tab down, which would be the home purchase tab. And so we assume maybe a purchase price of $275 for a home. We're going to talk more about loan programs and underwriting guidelines for loan programs. But generally speaking, if we're considering a conventional home loan product, the minimum down payment is 3% of the purchase price. So we have that kind of calculated here. So $275 purchase price, 3% down payment. We also want to consider taxes. We're going to pay property taxes for whatever county we decide to purchase in. We have estimated homeowners insurance. Also, maintenance cost needs to go into our calculation. So those are all kind of factored on the homeownership side. And then we also have to consider, what's our loan look like, right? So what's the interest rate environment look like? Well, we're going to talk about interest rates in just a bit, but generally speaking, most first-time buyers are going to elect a 30-year fixed mortgage. Average interest rate is kind of bouncing between 6.75 to 6.8%. We have origination charges, which ultimately that's the charge that a lender is going to institute for the financing for your loan. Here's one of another great benefits that we provide to our Mississippi State alum. Now, beyond just providing our classwork throughout the year, we also discount our services for you as well too. So whether you're thinking about purchasing a home or even refinancing, we discount our services by $750 to help you really make things more affordable for you ultimately. And then in purchasing a home, you do have the option of bringing down your interest rate by paying what we call as discount points. And discount points is where you're paying additional out of pocket, which generally a point equals 1% of your loan amount. And that 1% will usually equate to about a 0.25% reduction in overall mortgage interest rate. Now, in the elevated interest rate market that we're in, not many of our clients will choose to pay discount points. In fact, we don't generally recommend it right now because it usually takes about 3 to 4 years to break even on investments like this. So we would encourage clients to maybe hold on to that investment, and maybe when they consider refinancing a couple years from now, when maybe rates normalize a little bit, it might make sense to make those investments. So we don't certainly we want to pour expenses into a mortgage that may not make good financial sense for a client. And then we have also other settlement services. Those are going to be considered like title and escrow fees, some of the lender cost, maybe some of the local county fees that you might have in your home purchase. So those are all kind of baked into this calculation. And then finally, the last tab is other assumptions. And those assumptions include, what does the appreciation rate look like for my home? How long do I think I'm going to be in this house? If I decide to sell, and so like we expect this future home buyer to be in their home for 7 years. So if I sell at the end of 7 years, what's that going to look like for me? Because I will have to pay expenses to sell my home. And then we want to factor in state and federal taxes, as well as when we compare that to a savings rate of a home, right? So if we were to kind of look at, let's say from a budget perspective, let's just kind of side by side comparison the payments, right? So we know that our rent side has us at about 1,500 a month in rent. If we consider homeownership, we have to prepare ourselves from a budget perspective that we're probably going to go up to about 2,300 a month. So that's an $800 variance in payment. At the same time, we have to look at what's that opportunity cost look like over that span of 7 years, because even though I'm going to be paying an additional $800 a month, by the appreciation in my home and the potential tax benefits, I have an opportunity of creating about $45,000 in savings by owning versus renting. And now that number could look even better 2 years from now. Like, let's say I decide to purchase in 2025 at 6.75, but then maybe I decide to refinance my home 2 years from then, and now rates are 5%, right? That lower interest rate will create better savings for myself and then skew even better to the homeownership side. Now, obviously, cost of living or the housing market that we're deciding to purchase on will determine that affordability metric, right? So whether I'm buying in Arizona or Mississippi, those housing costs might look a little bit different. And, ultimately probably income levels might look a little different based upon those particular markets. But I would encourage our audience, if you have time, try to dive into that calculator. I think you'll find the exercise super useful. And you're going to hear me talk a little bit tonight about meeting for us for a consultation to design a home buying plan. We're going to help you kind of sort through like a budget, what that could look like for you. But I think tools like this can be a great kind of barometer for what homeownership might look like for you. Now, housing market trends and what's really ultimately going on today in the housing market can drive buying behaviors. What's interesting is in 2024, the housing market looked a little weird, to say the least. And a lot of it obviously was impacted by elevated interest rate environments. But the buyer kind of demand really diminished from what we typically see in the spring buying months. So usually in the markets, April and May kind of launches into the more busier times of the buying season. But this year was a little bit different. We actually didn't see the buyer demand start to pick up until July, even August this year. I think the psychology of the average home buyer was as such that, I think in April and May, people were still waiting to see our interest rates going to come down. That never happened. And then we get to July and August and people are thinking, well, I think I need to get into this market before rates do eventually come down, because then I'm going to kind of be left on the sidelines. And so you've seen the buyer demand start to pick up quite a bit. And so even in today's market, where right now we're in the winter months of home buying, when you'd say traditionally that's probably pretty slow right now, it's actually not the case. There's a lot of buyers trying to get into homes either before the holidays, or sellers that are maybe thinking now about selling before the end of the year. So the market is actually starting to pick up a little bit too, even though we're not in the ideal rate environment today. The question is, though, where does the housing market go in the next year or two? I think I get a lot of questions about what we're going to see post-election with the housing market, interest rates. Obviously, we still don't know at this point. You can look at our kind of a slide that we have for the last 3 years in the housing market, and you can see most recently we're seeing in some markets kind of a little bit of an incline in prices. So prices have gone up. Part of that is attributed to what's going on inventory-wise. So even though buyer demand's picking up, there really isn't a lot of inventory to support that demand of buyers. Now, new home builders are trying to pick up production to make up the gap. But ultimately, I think that's where our challenge lies projecting out into the next year or two, is how many more homes are going to come on the market that can support the buyer demand. So even if interest rates go lower, buyer demand will pick up. But if there's not the supply there, that's where our challenge might be. Now, part of why we have an inventory challenge is because back in 21 and 22, or 2020 and 2021, existing home buyers, or owners, I should say, decided to refinance. They refinanced at 2.5, 2.75, 3% rates. And many existing homeowners don't want to trade those out for, a 6 or 7% interest rate in today's market. So that's the dilemma that the housing market's in a little bit. I will have to say I am seeing some existing homeowners say, hey, you know what? I really want to move to a different part of town, or I really need to get a bigger house or a bigger backyard, whatever it is. So I think you're going to start to see that seller demand seller psychology start to shift a little bit, and kind of make some concessions on those interest rates that they currently have. clearly interest rates will drive not just seller motivation for selling, but buyer demand, right? And so this is kind of a look at interest rates over the last 12 months. And there's no surprise, it's been a little bit of a roller coaster for us in interest rates. So this 12-month look back, it takes us back to, December of last year. And then going into November of this year. So, average interest rate is about 6.8. We are at elevated levels. I think it's important to understand, like, why are we here? Well, part of it's because the Federal Reserve is trying to control the inflation, the costs that we pay, right, for goods, services. And so the Federal Reserve rate has been elevated, right? Well, we're starting to see inflation start to cool a little bit, not at the levels that the Federal Reserve is looking for. The Federal Reserve goal of inflation is 2%. Right now, we're at about 2.6%. So interest rates still remain elevated. We have seen the Federal Reserve cut rates 0.5% in October. November, there's a 0.25% cut, and we're hoping there will be another 0.25% cut in December, but we're still kind of in a to be determined situation with that. When the Federal Reserve decides to cut rates, it doesn't necessarily equal a one-to-one ratio reduction in mortgage rates, but it does immediately impact credit card rates, personal loans, auto financing, and it does have a ripple effect into mortgages. So as we get better clarity on what the Federal Reserve is going to do next month, we will hopefully see interest rates start to come down a bit. But it has certainly been a rocky ride in interest rates, and you can see kind of what we've experienced here. This dip right here in interest rates, just to comment on that, that was when the Federal Reserve, it was pretty much assumed that the Federal Reserve was going to cut rates 0.5% in October. Well, unfortunately, just shortly after that, we got an unexpected, really strong labor markets reading, which kind of set the markets back the other way because we were all really super excited. Interest rates dropped to like 6.1%. And then we got it's a good employment number, but bad for interest rates. And so that's why we saw interest rates kind of tick back up. I think as we forecast out where interest rates are going, some of the early forecasts I'm getting is for interest rates to hit 5.75 by the end of 2025. It's still, I think, a little bit up in the air. We may not see a lot of movement in interest rates in 2025, but it'll really be determined on kind of what this landscape looks like economically, with what the labor markets are doing, and certainly what inflation is doing, and kind of really what the geopolitical environment looks like as well too. Now, interest rates are not the same for all clients. And I think that's important to understand. There's various characteristics that go into interest rates, like credit eligibility, the type of product that I want to select, how much I decide to finance, what my down payment looks like. So if I'm putting 3% down versus 20%, those interest rate options might look a little bit different. And then we talked a little bit earlier about it during our buying versus renting calculation exercise, which is if I decide to pay additional costs out of pocket, I have the opportunity to influence my interest rate lower in that way. And then the term of my loan can also change my interest rate. So generally speaking, going from a 30-year fixed loan to, like, say, a 20-year or maybe even 15-year fixed loan, that can lower my interest rate, but it will obviously raise my payment because it's a shorter term to repay my loan. As we get a chance to meet with you for what we call is a home buyer consultation, we're going to design a home buying plan that makes the most sense for you, given your budget, from a sales price perspective, monthly budget, and of course your investment that you can make from a down payment perspective. All right, before we talk a little bit about credit, I want to just take a quick little pause. Any questions so far on some of the content we've shared with you guys? If you do have questions, you can use the Q&A function in Zoom. And I know we have some of you that are kind of joining late, so I know we're teaching this class in different time zones. So, but if you do have any questions, you can use the Q&A function in Zoom, and I'll get those answered for you. Well, when we think about credit, kind of go back to maybe some of the challenges that some of our first-time home buyers have. There's usually two challenges to home ownership. It's either one, I haven't quite got enough savings together for home ownership because it's just, I just got out of school and maybe I have some student loan debt, whatever the case may be. Or it could be around credit because maybe I have some legacy issues with my credit, or I'm a little bit more overextended than I would like to be. So let's talk about credit, because when we look at credit, that's an important component to making sure that we can optimize financing for clients. And I think it's important to understand the way credit scores are set up. Now, there are 3 different credit agencies. You guys are probably all familiar with them: Equifax, Experian, and TransUnion, right? Well, each one of those agencies have 3 different models in there, and those models pertain to credit cards, and the financing around that, auto financing, and then mortgage financing. Of course, on the housing side, we're going to use the mortgage model because, of course, that's what we're looking to evaluate for our clients with their plans. Let's take a look at the weighting of the FICO score calculation as it relates to mortgages. So 15% is going to be how long have I had credit? So the more mature, more kind of history I have in credit, higher my score could potentially be. 20% is going to be how much new credit do I try to get access to? Am I trying to open up new accounts? Do I have institutions running hard inquiries on our credit report or not? The more accounts I have opened in the most recent 6 to 12 months and the more inquiries I'm trying to do, that could have some damage to my credit score. Quick side note for us here around hard inquiries versus soft inquiries. Hard inquiries can impact your score. By credit laws, you do have a 30-day window of time to shop around with as many lenders in the mortgage space as you need to make a good decision. And it's the equivalent of one credit inquiry impact your score. To take that concern off the table and starting the process with us, we actually only do a soft credit check in working with our team because a soft credit check doesn't impact your score. It just gives us visibility to your pay history and your credit so we can design the right product for you. So just something to kind of consider as you're, looking at maybe options of meeting with us for home buying plans. 30% is going to be around revolving credit. And right there, we're looking at your credit card balances versus your credit limit. So if I have $10,000 in limits, but my balances are $5,000, I'm currently at 50% utilization of credit. Now, if I'm at $8,000 in balances, then I'm a little higher, right? Now, my score might be a little bit lower because let's say I'm at 80% utilization. If you're trying to optimize your credit score, I would encourage you to get that utilization to 10% or lower. If you're that client that maybe is at 80% because maybe you've just recently acquired some new debt, our step one would be kind of let's work towards 50% utilization. Once we got that under control, then we get to 30% utilization and then work our way down to 10% utilization. Now, if you're trying to figure out how do I make a quick fix to my credit in around credit utilization, let me give you a quick tip around that, which is if you take a look at your credit card statement, there's 2 dates on the credit card statement. One is the billing cycle date. 2 is the due date. Now, the due date is obviously when your payment's due, but the billing cycle date is when the credit card issuer closeouts the activity for the preceding 30 days and then sends out the information to the 3 credit agencies. If you can kind of get in the habit of paying down your credit card balances before the billing cycle end date, whether paying them off or paying them down, it's going to allow you to get current data reported out to the agencies that show lower utilization, which will in turn help you lift your credit score. Last component is payment history. That's pretty self-explanatory, right? So my payment history, I'm looking at, especially over the last 12 to 24 months, what my payment history looks like. If I've had any late payments, they'll be categorized as 30-day lates, 60-day lates, and then 90-plus day delinquencies. The more severe, I guess, I am, or the more number of days I'm delinquent, the bigger impact I'm going to have to my credit score. Now, every credit agency is going to deliver a score to us. So, we'll have one from Equifax, one from TransUnion, one from Experian. So let's say in a real-time example, let's say my top score is 760, my middle score is 740, and then my lowest score is 720. From a qualifying perspective, we're going to take the 740 credit score for eligibility in financing. So we would call that the middle score. That's important to understand because that can influence your cost of your interest rate, the type of product we can select, and then your mortgage insurance for your home financing. Now, if I'm going to apply with my partner, but let's say my partner has slightly lower scores. Let's say the best score is 700, the mid score is 680, and then my lowest score for my partner is 660. Well, in that scenario, my partner now carries the lowest middle score. So that middle score of 680 would be used from a qualifying perspective. So, and we're going to talk through that as we meet with you for a one-on-one to figure out what's the optimal way of structuring financing so we can get the lowest priced option for you. But I just kind of want to have some transparency with you on kind of how we look at those credit scores. Now, another tip for you around managing your credit as it relates to account closure. You can see our length of credit is 15% of the weighting, but if you decide to close out a revolving account, just be careful before you do that because when you close out an account, you can do 2 things that impact your score. One is if it's a more seasoned account, once you close that out, it takes away all the history from the credit bureaus. 2 is that you now lose another credit line or credit limit in your aggregate totals for utilization, which can also impact you too. So just be careful that even though you might be frustrated with the company or you're paying an exorbitant annual fee, just kind of think through like other credit cards that you have before you decide to close out that account. And then, I think just bigger events that we see on credit reports like bankruptcy, short sales, collections, they're going to have a lasting effect there or longer effect. But typically, events like that will be the most impactful in the most recent 12 to 24 months from the date of the event. Now, speaking of kind of challenged items in the past, like legacy items on your credit, this is a matrix to show you how long those items will stay with you. Again, it's kind of be the biggest impact is in the most recent 12 to 24 months. Now, they may make an impression on your credit report where they like stay on your credit report, but how it hits your score will be in the most recent 12 to 24 months. As you move further away from the date of the event, you should start to see some organic improvement in your credit score. Now, student loans come into the conversation as I meet with clients in different parts of the country, and student loans are obviously a reality for those of us that graduated, and we have to kind of factor those into the calculus for home buying. Now, federal student loan debts, if you're trying to now start a new payment arrangement with federal student loan providers, that can be a little bit difficult because I think there's litigation holding up income-based repayment programs. So if you don't have a set payment arrangement right now, that may be a little bit difficult because we want to kind of look at whatever that payment arrangement is to factor into your qualifying. But there are ways to still qualify, and we can take like the total balances, and for a conventional loan, we would use 1% of the balance as your monthly payment for qualifying. If you're doing an FHA loan, we take 0.5% of the total balances in the calculus. If you're on an income-based repayment amount, let's say it's $250 a month, then we can take that payment right away, not a big deal. But I know I've had some challenges for clients that are trying to now obtain new payment arrangements. And right now the Federal Services, federal student loan servicing companies aren't taking payment arrangements currently. If you're in forbearance or deferment, even though there's no payment actually being made, those accounts still have to be factored into the calculation for qualifying purposes. So if I'm, working on my master's program right now, I don't technically have payments. If you're looking to apply for home financing, then those would have to be factored into the calculations. The reason why we have to include those is because all loan programs have guidelines or underwriting guidelines that tell us as a lender what we can and can't do. And part of that is just the student loan guideline requirement. So I do want to spend some time talking to you a little bit about loan programs because I think it's important to understand what your options look like as a future first-time buyer. And let's kind of dive in and we'll look at it like a high level at each one of these programs. You've probably have heard of them in the past, whether it's you're doing your research or just kind of in the news. But the first product is the conventional loan program, and that's Fannie Mae and Freddie Mac. You may have heard of them in the news, especially during the housing crisis of 2008. But today, Fannie Mae and Freddie Mac are under conservatorship of the U.S. government. So it does have kind of influence, if you will, from the U.S. government, but it is kind of they're independent agencies. Fannie Mae and Freddie Mac have about 70% of all originations across the country. With Fannie Mae and Freddie Mac, there is a minimum down payment of 3% for a first-time buyer, up to the conforming loan limit of $802,650. So that's a conforming loan limit. That's applicable for Mississippi, Arizona, Texas, all across the country. That's the conforming loan limit. Now, I don't think we have anybody in our audience today from some of our high cost of living areas. So like if you're in certain parts of Florida or Virginia or New York or California, but in some parts of the country, high cost of living areas, you can finance more than 802,250. In fact, you can go up to 1.149,825. It's called the high balance loan limit. Where things kind of change up there is the minimum down payment goes from 3% to 5%. Regardless of that kind of increase in loan amount, the minimum credit score on a conventional loan is 620. And you're going to learn more about private mortgage insurance in our next slide. But ultimately, private mortgage insurance comes into play when I put less than 20% down to purchase my home. Next product is an FHA loan. That is truly a government insured loan. FHA stands for the Federal Housing Administration. You can see on screen that we have a minimum down payment of 3.5% on an FHA loan. Now, the loan amount will vary by county with an FHA loan. So, right now we're using kind of a baseline number of $498,250. But, if you're buying in Maricopa County in Arizona, that a limit's going to be a little bit different out there than it would be, say, in one of our Mississippi markets. So with the FHA loan, minimum credit score of 580 has a lot more flexibility in terms of eligibility than you would see from a conventional loan product. And FHA gets a little bit of there's a little bit of a misrepresentation with FHA that it's just for first-time buyers. It actually can be used for second and third-time buyers. There's really no restriction around that. The next product is the VA home loan. That's for our veterans that have eligibility for the VA home loan. The VA loan's a great product that allows veterans that have at least a minimum credit score of 620 to get access to the program. There really is no limitations around loan limit. And one of the biggest benefits is there's a zero down payment option for the veteran. In fact, some of our veterans that have any partial disability from the VA, there's a thing called a guarantee fee, or I'm sorry, VA funding fee with the VA product that is completely waived when a veteran has any type of partial disability. For most veterans that are first-time users, the VA funding fee is usually about 2.3% of the total first mortgage amount. Now, USDA actually has guarantee fees. That's the next product we're going to talk about. USDA is for clients that want to buy in more rural areas. The guarantee fee basically is charged by the USDA. It's usually 1% of the total loan amount. USDA has two qualifiers to it. It's based upon the location of the property. Many of our markets in Mississippi would be considered USDA eligible. And then there's basically income limits by the county or location, I should say, of the property for USDA. So the big advantage with USDA, it's a zero down payment option. And it allows buyer to get access to home ownership in those more rural areas with a minimal amount, of course, out of pocket. And then finally, the next product is a jumbo loan. Not really something a lot of first-time buyers are going to be looking at, but ultimately with a jumbo loan, it gives you a little bit more buying resources for those that need to purchase maybe beyond the conforming loan limit or high balance loan limit, depending on where they're purchasing. It does have elevated down payment requirements of 10 to 15% and usually higher asset requirements. Now, I kind of alluded to a little bit about PMI, which is private mortgage insurance. So we're going to talk a little bit about private mortgage insurance around conventional loans, and then we're going to talk about mortgage insurance for FHA or government insured loans. So we get a lot of questions around this, and I think it's important as first-time buyers to understand how those instruments work. A conventional loan requires private mortgage insurance when you put less than 20% down. Now, there's different ways to pay PMI. You can pay it monthly. You can split the premium up between monthly and some upfront. You can also do a single premium where you completely buy out the mortgage insurance with an upfront cost. And there's also what we call as lender-paid mortgage insurance, where you essentially take a higher or elevated interest rate in order to buy out the mortgage insurance. The most common option by most buyers is the monthly mortgage insurance. And the reason why that is because mortgage insurance on a conventional loan has a cancellation option. So essentially, when I reach at least 2 years in my loan and I have at least 20 to 22% equity, I can apply to have the mortgage insurance canceled. Okay. Now, in working with buyers across the country, there's a little bit of a misconception around what PMI looks like from a cost perspective. And especially if those of you in tonight's class that maybe have already spent some time looking on Zillow or Redfin and doing some calculations on, what that looks like for you from a payment perspective for a particular house, the PMI can be a bit misleading because PMI is calculated based upon credit score, down payment, and then the amount financed that you have. But most calculations online, especially on Zillow or Redfin, don't have that baked into their calculation. So what we found is that those payments might look a lot different. So let's take a look at a PMI example for you here. So the PMI, let's say we're looking at a loan amount of $250,000. Let's say I'm putting 3% down. I have a credit score of 740. My PMI in that example would probably be about $135 a month. Okay, so probably looks a little bit different than what you've seen in your online searches. Now, let me quickly, just before we talk about FHA, let me just explain to you what PMI is, because I think that's kind of a disconnect for many of our buyers. PMI, obviously we know it stands for private mortgage insurance, but ultimately it insures the lender against default by the buyers. So, and that's reason why we see premium costs vary based upon, credit score, down payment, amount financed. Because if I'm a higher risk borrower with maybe a lower credit score, well, maybe that premium is going to be a little bit higher for that cost, right? And so that's the PMI ultimately protects the lender against default. Now, FHA has very similar insurance. It is mortgage insurance, but it has two components to it. There's upfront mortgage insurance, which is the equivalent of 1.75% of the loan amount. There's also monthly mortgage insurance, which is 0.55% of the loan amount. Now, different than a conventional loan, FHA mortgage insurance can only be canceled if you refinance out of the FHA loan, whereas conventional gives you that option at the end of 2 years. Now, FHA mortgage insurance, if we compare the same loan amount of $250, you're going to have those two components: monthly mortgage insurance, which calculates out to $114 a month, and then you have upfront mortgage insurance, which is $43.75 a month. So, you're going to have a little bit of a lower monthly cost from the FHA perspective, but the upfront cost will be a little bit more significant with FHA. So when we look at these numbers, obviously there's a little bit of comparison there and things to think through. But ultimately, FHA is going to allow a little bit more flexibility and guidelines in the qualifying for a buyer versus what we would see in a conventional loan. So if I give you an example of, let's say, someone that had a delinquency on their student loan of 30 days back in October of 23, that might be difficult to overcome with a conventional loan, but with an FHA product, we would probably have a higher success rate. Okay. So, as we meet with you to design your own home buying plan and create some goals and objectives for you in the years to come for home ownership, we'll figure out what the right product match is for you, at least today. And, maybe if we start off at an FHA loan, we can put some framework in place to help you work towards a conventional loan if that's the better option. But ultimately, you have different choices around that. Now, as we're preparing for home ownership, we're going to have to kind of do some legwork in getting some documents together. I provided you a little bit of a document checklist here. You can see us, you generally would need your last couple of years of W-2s, recent pay stubs, usually bank statements will have to be brought together. Most of the documents we want to see will be in the last 30 to 60 days for you to get a good kind of look into what your finances look like to help validate whatever it is in your application. Now, in this section, we want to talk a little bit about income. As I work with clients across the country, inevitably a lot of questions come up around employment. When we think about employment, we always have to verify the last 2 years of history in employment. Now, that history can look a little bit different, but ultimately, we have to show that you have at least a combination of 2 years in income from like an employer and or education. So many of our attendees to our classes are recent graduates, for example. And let's say in a scenario where we had someone that graduated from Mississippi State in the spring, they just started their job here in the fall. Even though I may not have 2 years on my job, I still could potentially qualify for a mortgage because I have my, say my 4 years of undergrad at Mississippi State, and then I started my job. So now I can fulfill my 2-year requirement. So you don't necessarily have to be on the job 2 years. We just have to show a 2-year history. Where that 2-year requirement maybe get a little bit more challenging is if I have dual employment. So if I'm working 40 hours a week for one employer, and then I have, maybe an additional 20-hour work week job, in order for me to count the 20-hour work week job, I would have to show that I've been working on both jobs simultaneously for the last 2 years. All right. If I'm self-employed, like let's say I'm an independent contractor, I file a Schedule C on my taxes. In that case, I do have to show that I've had 2 years of consecutive tax filings to make sure that income is eligible. If I've like working a 40-hour work week job and maybe I drive for Uber on the weekends to make some additional money, totally fine. But in that case, we have to show that we have 2 years on the job and then 2 years working as an Uber or Lyft driver, or whatever the case may be. Last thing I want to touch on before we move along into our debt to income ratio discussion is looking at other income sources. So sometimes we'll have clients that have room rents and they want to factor those into the calculation of their qualifying. Generally, those still can't be used unless we're going to be purchasing like an investment property and we can show income streams through that way. And the other thing that comes up is like if I have a partner that wants to, or my partner contributes to the household income and expenses, but they're not going to be part of the application. So unless they're part of the application, most products do not allow us to use those alternative income sources unless that person is part of the loan application. Now, one of the things when we do in analyzing income, we analyze income versus expenses, and that's called a debt to income ratio analysis. Pretty simple calculation, which I'll walk you through in just a few minutes. But ultimately, we're looking at your pre-tax income versus your outgoing monthly obligations. Now, we're not looking at like daycare expense or entertainment budget or vacation expense. Those things aren't factored in. It's generally just going to be things that are reportable to your credit report, like personal loans, auto loans, credit cards, and of course the new mortgage. Generally speaking, we don't want your expenses exceeding more than 43 to 45% of that pre-tax number. At times it can go as high as 50%, but the general rule of thumb is 43 to 45%. So if we looked at a real-time example here, we have a client that is paying currently on their new mortgage with principal and interest, the property taxes and insurance, so that's PITI. I told our group yesterday we love acronyms in the housing industry. We do a lot of that. But PITI stands for principal, interest, taxes, and insurance. And then PMI, we learned about private mortgage insurance. Some communities that you purchase in have HOAs or homeowners association dues. So we'll take that as our housing expense, and then our other debts being $500 a month. So our total outgoing expenses are $3,000. And if I'm making $8,500 a month, that means my debt to income ratio is 35.29%. So that's what we'd be looking at. Now, most clients are not going to feel comfortable when we're in that 43 to 45 or even 50% range, right? The question I get is like, what's the comfort zone? And I think for most first-time buyers, it feels good around 33 to 36%. So 33 expenses to income ratio. But it varies for everyone at different parts of the country. At times, if I'm buying in a higher cost of living market, I might have to increase that debt to income ratio a little bit. But ultimately, wherever we land on budget, there's two really big goals for you in homeownership that we have at least. One is we want to design a plan for you that's affordable, because that's really important. That's ultimately what I just shared with you is just a metric for qualifying, but it's not affordability. Two is sustainability, right? So as we purchase our home, things may change financially for us, and we want to be able to kind of weather the storm of handling our mortgage responsibly, even though things may change for ourselves. So those are kind of the two big goals we think about in home ownership. The last stop we want to make before we talk about the workflow of buying is savings. And that can be the second challenge for home buying, whether it's credit or savings. Now, there is some documentation that we ask buyers to prepare in looking at what assets are available today, whether that's checking and savings accounts. Sometimes we can use 401ks, 403bs, even IRAs. I'd encourage you to talk to your financial or tax advisor before you access those assets, but they can be potentially used. Even family members can help out with what we call as gift funds. But savings being the biggest challenge for home ownership, I like to kind of talk through a really simple exercise that you can go through in your own finances to help you start saving for home ownership. And let's go take a step back to our example that we start off in today's class, which was our budgeting exercise, right? We had an assumption that, we're paying $1,500 a month in rent. We think we can spend about I think it was about $2,800 or $2,300 a month from a housing perspective. So what I would coach our clients to do in that type of scenario is if we're struggling with meeting kind of the mark from a savings perspective, start at the first of the month saving like we're actually paying that mortgage payment today. So even though I can afford, let's say, $2,500 a month in mortgage payment, I'm only paying $1,500 in rent. So if I have a surplus of $1,000 a month right now, right, or I believe I have $1,000 that could go into a mortgage, why not start paying myself into my savings account like I'm really making a $2,500 mortgage payment, right? So on the first of the month, when I pay my landlord, take that additional $1,000, that automatically gets transferred to my savings account. At the end of 6 months, I have $6,000. That's a start, right? At the end of the year, I have a $12,000. And for most of us in some of the markets that we're talking about today, that would be enough to help me with my down payment and my closing costs to purchase a home. And so it does that discipline of creating savings. But the second thing is it gets us in the habit of making a larger mortgage payment, right? Because it is a transition for most of us to go from renting to buying a house, and it's a bigger payment, right? So there's not as much payment shock to us as a first-time buyer. If we're in the habit in the next 6 to 12 months of just paying that kind of payment, then it makes, like I said, the transition a lot easier. Now, savings, even though it's a challenge for us, there are resources available to us across the country that can help aid low to moderate income buyers in home ownership. There's a national program called the Freddie Mac Borrow Smart program, provides a grant of anywhere between $500 to $1,500 in home ownership that can help kind of decrease the total out-of-pocket expense. There's also a program available in the state of Mississippi, the MHC, Mississippi Housing Program, that allows you to get anywhere between $6,000 to $10,000 in assistance. There's also options for a lower 30-year fixed mortgage rate by using some of these programs. So while it may feel like a big daunting goal for you to purchase a home because maybe it needs to be a 3 or 4 year savings goal, first-time buyer assistance programs can really make it a much more closer goal for you. I know we have guests in different parts of the market. So even in Arizona or Texas, there's also very similar assistance programs. I would encourage you get connected with me after tonight's class. Would love to be able to walk you through what some of those different resources could look like for you. Well, let's talk a little bit about the buying process. So after tonight's class, you may say, hey, you know what? I think I'm thinking more about homeownership and I want to put a plan together for myself. Maybe it's just some goals or a roadmap to homeownership. Let's kind of show you how we get started with that and where we kind of would go from there to ultimately get to the finish line of getting keys to my own home, right? So step one, and this is kind of a visual aid for home buying. Step one is a pre-approval, and the pre-approval is really the output of a consultation with us. Ultimately, a pre-approval signifies to a seller that you eventually present an offer to that I'm eligible for financing, right? It says all the parameters of my financing, and it's usually good for 60 days, but ultimately it can be extended for as long as you need. We've had some buyers that have been shopping for the last year or two, maybe even 3 years. So there's no pressure to go out and run out and find a home, but the pre-approval ultimately is the output of a consultation with us. So even if it's a goal for you for the end of 2025, I always encourage clients get connected with us sooner than later so you can start setting some goals for yourself. And what's nice about the time of the year that we're in, obviously we're going into the holiday season, but hopefully many of you are thinking about different goals for yourself. And that's not just financial goals. It could be a variety of different goals, career goals, health goals, vacation goals. But when you're kind of thinking about that, if in the financial goal category, homeownership is there for you, now's a really great time to kind of start exploring what those options look like so we can get a plan together for us. Now, going a little bit further down the process, step two is house hunting. That's where you get a chance to go out and look at homes. So it goes from looking on Zillow and Redfin to actually going out and looking at homes, trying to find neighborhoods that fit all the criteria for you. I would encourage you get connected with a local realtor. We have a preferred network that we can connect you with, a realtor, but they're going to be a really a great resource for you to find the right home for you. But besides that, help negotiating in contracts with the seller. Now, as we continue down this path, step three brings us to an actual agreement with the seller. So maybe I've been looking for homes for the last 6 months, then I find a home, I make an offer, seller accepts my offer. That's great news. And that day you have your accepted offer, you get a call from us saying, congratulations, you've got your offer accepted. Let's talk to you a little bit about next steps in the process. And one of those next steps is to do a follow-up consultation with us. Now that we know what your agreement looks like with the seller, let's figure out what your financing looks like. Let's talk about what today's interest rates look like, what your payment might be, your out-of-pocket expense. Make sure everything is all designed properly. Now, you do have some action items as a buyer. Once your offer gets accepted, you have to make an initial deposit, which on average in most parts of the country is 1% to 2% of your sales price. Those funds will count towards your total expected out-of-pocket expenses. Now, it also kind of kickstarts some different things to happen, like getting your house appraised, which we will do for you as your lender. Your realtor will have inspections done on your house, and we'll get your loan approved. In most parts of the country, those are all covered under what we call as a contingency period. That contingency ultimately allows you to kind of do your investigative work in the first maybe 10 to 17 days of the contract period. So if today starts day one, I have usually about 17 days to do my due diligence on the property. It's really important because that contingency period ultimately kind of protects your deposit. So if something just isn't up to your expectation, then you have the option as a buyer to potentially cancel the contract to get a refund of your deposit. Step four brings us to more of the administrative functions of the loan, and that kind of comes after our follow-up session with you. But at that time, we may have locked in the interest rate. We verified assets, employment. We have all the design work done for your financing. And then we kind of continue down this path to step five, which is the underwriting process of the loan. An actual underwriter reviews all the criteria of your loan, making sure it matches the product that we've selected for you. And at that time, that approval gets issued. That also takes us to about 3/4 of the way through the process. So we're almost at the finish line. So at that time, once your loan approval is back, then you also have your appraisal and probably your inspections are back. If you still feel really good about the property, then your realtor will help support you in removing your contingency. Ultimately tells the seller that now you're ready to move to the final closing stages. As a lender, we're going to issue to you your final closing disclosure, which ultimately gives you a 3-day cooling off period. before we sign final loan documents in person with a public notary. So most steps in the process from the loan perspective can be done all via e-signature, but still a little bit old school right now in the industry. Some of the stuff can be done e-signature, but most final documents that are recordable documents are done in person. So you'll do that at the very end of step 6. You also wire in your final funds at that time. Those monies get reconciled along with your loan financing, and then documents get recorded with the county recorder's office wherever you're buying. They generally record a grant deed to transfer ownership, as well as the deed for your new loan. And after we get confirmation of those documents being recorded, I get to make the favorite call of the day, which is to congratulate you on being a new buyer. It's an exciting day for all of us. I mean, we're thrilled to be able to help support our clients on that journey. And it's really great because for us, most often it starts right here in class, right? It starts about just understanding more about homeownership, building a plan, and then helping you get on that path towards homeownership. If you're thinking about joining us in that journey, we'd love to be able to get connected with you for a consultation. It's a really simple process. It's a 3-step process. It starts with an online application, uploading some easy income and asset documentation, and then using our scheduling system to schedule a video session. That video session is a one-on-one with me, and I'm going to help you kind of design some options for you to help you better understand what that might look like for you in homeownership. And the consultation is a free service. So that's one of the big questions I get is, how much is it going to cost me? So there's no charge for that. We just want to help educate you on what your options look like for you. So like I said earlier, whether you're deciding to buy in 2025, or this is maybe even further out, we would love to still get connected with you and just kind of map out a plan together. So we're going to talk in that session about where do I want to buy? What's my budget look like? Do I need some help around credit? Can I utilize some assistance programs? Where in the process do I need to start finding a realtor? All those things we're going to kind of talk through in that consultation. All right, well, we're getting towards the end of class, but I want to spotlight one of our resources that are available to you that I think it's a really great tool available on Android and Apple devices. That is our mobile app. It's called our APM mobile app. You can start the application process via mobile. You can follow the progress of your loan. You can even use the calculator function to kind of do calculator functions on homes that you're looking at to get a sense of what the payment might look like. That doesn't replace the human touch side of our business. I mean, we try to really leverage technology quite a bit in our industry, but this is going to be the biggest purchase you guys decide to make whenever that time comes. So, we're always here with the human touch side of things to provide you good counsel, to be accessible by email, phone call, text, all of that. We're here to help you on this journey. And then finally, we're super proud of our Mississippi State Alumni Association partnership. This is our first year of partnership. We've taught 4 classes. They seem like they're growing every class, which we love. But we also have other partnerships across the country. So if you have friends, family, or coworkers that could think would benefit from a class like this, we'll probably be teaching. We have only a few classes left for 2024 because of the holiday season, but we should be teaching probably anywhere between 60 to 70 classes just like this in 2025. So we'd encourage you to share the information with others. Here's all my information, by the way. So if you have any questions after tonight's class, feel free to reach out to me, whether that's text, call, email. We want to get you all the answers you need, whether that's just getting connected with us for an introductory call or a consultation. And, we will have this class up on our YouTube channel tomorrow. You can find that at JMeda Mortgage. We'll send you all the links, but feel free to do some look backs at tonight's class. Hopefully that'll be helpful for you. And, we do try to put a lot of good content on our social channels on Instagram. And we really want to celebrate homeownership. So we have a lot of great testimonials, I think, in our local communities of just success stories with home buyers that started off right in the same seats that you're sitting in today, that were just kind of just thinking about home ownership, and 2 years later, now they're actual homeowners. So I got you out of class here before the top of the hour, but I didn't get a lot of questions tonight, but I just want to kind of open it up for any Q&A. You can use the Q&A function or chat. I think the Q&A is accessible, should be working okay. But any questions from tonight's class before we wrap up tonight? Many of you are hanging in there. Let's see. Any questions? Okay. All right. Yeah, I'll just give it just a minute, just in case anybody's typing away. But I think we got it. So, well, I hope that's a sign that I was super thorough since we didn't get any questions. But we very well attended class. I do appreciate you participating and joining this class, and I do hope we get a chance to get connected at some point to help design your own home buying plan wherever you are at in the country. It might be the afternoon or the evening, but regardless, enjoy the rest of your day. Look forward to seeing you all soon.